At this point, you've already read the chapter and you've already watched lecture videos with another master budget example. So in this example, I'm going to go fairly quickly through some of the math and really try to focus on a review of the relationships between the budgets and where some of the numbers come from. In addition, I'm going to focus on the importance of this total column because it wasn't used by your authors. Your authors focused on, they used something here called a pro forma column, and they really used it much of the time for totals, but other times just to find computations of numbers that they were going to use on what they were calling pro forma financial statements, which is just another word for budgeted financial statements. I prefer the use of a total column because most budgets will have a total column that represents the budget information for the period of time that you're preparing the budget for, and they'll also separate out that time into smaller intervals. As we go through this, you'll see that the total column is often, but not always, just the sum of these separate smaller time intervals. I'll try to point out for you when the total column is a different number. Alright, well, let's get started. You have access to a couple of things that go along with this video. First of all, you should have the problem itself. It's the Attaboy budgeting problem. In addition, you should have access to a solution to the problem, or at least most of the problem. Attaboy is a retailer, so that makes budgeting quite a bit simpler than if Attaboy was the manufacturer of these jerseys. We'll be doing a master budget for Attaboy, which means we'll be doing all of the little smaller budgets, plus we'll actually combine them all together, combine all of that information, and be able to come up with budgeted financial statements. In this case, we're preparing a master budget for year 4. It's a quarterly budget for the year. So you can see that the total column here is more than a total. This column actually represents the budget for the year. Then over here, these are basically separate budgets for each quarter. So it's a quarterly budget for a year. We could have also chosen to prepare a monthly budget for the year. The total column would still represent a year, but you'd have months over here. Many companies now choose to prepare what we would call rolling budgets, where they're always budgeting at least, let's say, 12 months in advance. And every time a month drops off, they add a new month onto their budget. So they've got this rolling, always looking 12 months forward from whatever today is. If you have the problem in front of you, you should recognize these numbers. I've already done a lot of this for you just to speed us along in the process. Master budgets always start with a prediction of sales. That's the key that everything else in the budget will build off of. So here, Attaboy is only selling one product, these sports jerseys, and they are predicting what their sales will be in units. They probably got that information from the marketing department, and they know they have a budgeted sales price, and as you saw in the problem, there was a $2 increase in quarter 3 and then a $3 increase for quarter 4. So you see those sale prices being increased here. Sales revenue, of course, is just a formula, $21,000 times $40 each, and then that formula has been copied across. In this case, the total column really is the sum of the 4 quarters, and sales revenue is also the sum of the 4 quarters. You don't sum the sales price up, that wouldn't make any sense, and 91,000 times something wouldn't give you 3,796,000 because the sales price changed here. So mathematically, all we can do is just the sum of those 2 rows. You'll notice that over here, to the right of the total column, I have some information for the next quarter, for quarter 5 or In this case, it would be Q1 of year 5. And we need that information because some of our budgets look forward to compute things like a desired ending inventory number. All of the information that you used to build the sales budget was available in bullet number 1 in the problem itself. Now look down and read the information provided in bullet number 2. Bullet number 2 tells us another thing that's very important for companies. It tells us when they can expect to collect the cash for their sales. In bullet 2, you see that Attaboy sells all of their merchandise on credit. They collect 70% of those sales during the quarter in which they made the sale, 20% in the next quarter, and 10% in the quarter after that. In addition, if you look at the balance sheet that was included on the problem, you would see that Attaboy has accounts receivable of $353,000 at the end of year 4. The problem tells you in bullet 2 that $353,000 of accounts receivable on the balance sheet will be collected as follows: $238,000 in Q1 and $115,000 in Q2. So we had specific instructions on how they were going to collect the beginning balance in accounts receivable in this problem. Then let's think about the pattern. What the problem tells us is that Q1 sales of $840,000 will be collected 70% in Q1, 20% in Q2, and then 10% in Q3. So that's what we expect to see. So the underlying formulas here, this one you can see is sales in Q1 times 70%, sales in Q1 times 20%, and sales in Q1 times 10%. And if you add those three numbers up, they add up to the $840,000. You follow the same exact logic for Q2. Q3, you collect 70% and 20%, but you have not yet collected the other 10% as of the end of Q4. In Q4 sales, you collect the 70% in the month of the sale, but you haven't yet collected the other 30%. Creating the formulas and following that same approach, here's the collection schedule. I've added a cross for the total column. This is just a summation. I've done the same for every row down. And then I can do a double check. This number is actually summing things up vertically. This number down here is summing things up horizontally, and I often do that just as a quick check to make sure that I haven't messed anything up. In accounting lingo, we would say that we have footed and cross-footed our schedules. Now later on we'll be asked to compute what accounts receivable would be at the end of year 4. And this should highlight for you what accounts receivable would be. It's the amount you haven't collected yet, right? So you know you're still missing the third quarter, the last 10% of Q3 sales, and you're still missing the last 20 plus 10 or 30% of Q4 sales. That would be your accounts receivable at the end of the year. Now take a look at the information in bullet 3. Information there tells us how to complete Schedule 3 and Schedule 4 for our budget. It tells us that Attaboy estimates that they will have a gross margin percentage of 60% in year 4. Remember that gross margin percentage is gross margin divided by sales revenue, and sales minus cost of goods sold equals gross margin. So if the gross margin percent for a company is 60%, the cost of goods sold percentage for that company must be 40%, because sales minus cost of goods sold equals gross margin. In other words, 40% of Attaboy's sales is expected to be cost of goods sold. The other 60% would be gross margin. What we're interested here, what we need here, is the cost of goods sold percentage, because the first thing we're trying to predict for Attaboy is budgeted cost of goods sold for each quarter. You can see our sales here. They came straight from Schedule 1. If we multiply our projected sales times that cost of goods sold percentage, you get budgeted cost of goods sold. What we're trying to get to in this budget is budgeted purchases of inventory for Attaboy. The difference between the cost of what they're going to buy and the cost of what they're going to sell is the change in their inventory account. So that's what we have to adjust for here. We will add their desired ending inventory and subtract their beginning inventory, and that will give us cost of purchases for Attaboy. Attaboy, as you see in that same bullet number 3, Attaboy had a shortage of inventory last year. They weren't able to get as much inventory as they needed. So for year 4, they plan to keep 35% of next quarter's budgeted cost of goods sold on hand as ending inventory. So their desired ending inventory at the end of quarter 1, if we look at this formula, is 35% of sales for quarter 2. And we'll follow that same logic as we go across for these other quarters. Cost of goods sold plus desired ending inventory is their total needs, except that they already have some inventory on hand at the beginning of the quarter, so we subtract that. Beginning inventory for Attaboy is found on the balance sheet at the top of the handout. So if you look at that balance sheet, you'll see $10,000 under inventory. So that's where this number came from. Now, let's think about quarter 2. In quarter 2, we base our desired ending inventory on quarter 3 sales. So this number will just be 35% of the $386,400. Where do we get the beginning inventory for quarter 2? Well, you can see I've color matched these cells because the beginning inventory for quarter 2 is, of course, the ending inventory at quarter 1. If quarter 1 ended on March 31st, quarter 2 began with the same dollar amount on April 1st. So I filled the numbers in here for quarters 1 through 4, and you can see that logic happening. Desired ending inventory for quarter 2 becomes beginning inventory for quarter 3. Quarter 3's ending inventory is based on quarter 4's budgeted cost of goods sold. Now let's take a look at quarter 4. We have to do something special here. Beginning inventory comes from quarter 3, but quarter 4's desired ending inventory, you can't base it on the total column here. That wouldn't make any sense. You need to base it on budgeted cost of goods sold for the first quarter of year 5, and that's what we have in this other column off to the right of the total column. So this number came from what I had in the margins. Up here, I multiplied it by 40%, and 144,900 is 35% of that 414. Now let's take a look at the total column. This is where you need to pay a little bit of attention. I've added up total cost of goods sold. Think of this again not so much as a total column, but as a budget for the whole year. So if you think of it as a budget for the whole year, what's desired ending inventory at the end of the year? Well, it's the 144,900. Down here, what was our beginning inventory at the beginning of the year? Well, that would be the $10,000. So to make this column work mathematically, this needs to be ending inventory at the end of quarter 4. This needs to be beginning inventory at the beginning of quarter 1. After you make those formulas, go in and check the math. Cost of goods sold plus desired ending inventory will equal your total needs. Subtract beginning inventory, you'll get cost of purchases, and now this number will work both vertically and horizontally. You just need to make those adjustments, which just really requires thinking of this column as the budget for a year, not just as a total column. Moving down, we have a budget for cash. When do we pay out the cash for our inventory purchases? Well, that information is also in bullet 3, and it's pretty simple in this case. Our rule was Attaboy pays for its purchases in the quarter following the purchase. So quarter one's purchases get paid for in quarter two. Quarter two's purchases get paid for in quarter three. So the math here, the formulas here are fairly simple, as you can see up here. What do they pay in quarter one? Well, this $426,000 comes from the balance sheet once again. If you look at the balance sheet, you'll see that Attaboy had accounts payable of $426,000 at the beginning of the year, and that account payable was related to these inventory purchases. So that gets paid for during quarter one. What hasn't been paid yet as of the end of quarter four? Well, these purchases that were made in quarter four, they're not going to get paid for until quarter one of year 5. So remember, this amount is yet to be paid, and you'll need to represent that as accounts payable on your balance sheet. Total column here is just summing across. Alright, well now let's take a quick look at the selling and administrative expense budget. And again, there could be many ways to set this budget up. In this case, Attaboy has estimated their variable selling and admin costs as $10 for every unit sold. So the top line of this budget came straight from Schedule 1, projected units to be sold. The $10 was information that somebody computed, probably given historical performance. Below that, we have the fixed selling and admin cost. When you read the problem, it'll tell you that Attaboy has estimated their fixed selling and admin costs at $70,000 per quarter. Now what I've done on this budget, just to highlight an important point for when we get to the cash budget, is I've broken the fixed selling and admin down into the amount of that's depreciation versus everything else. Now in the problem, I tell you that $3,000 a quarter is depreciation expense. $70,000 minus the $3,000 tells us that the non-depreciation fixed selling and admin cost would be $67,000. We're going to want to know this number later on when we go to do our cash budget. Total budgeted selling and admin is just our fixed plus our variable selling and admin for each quarter. And in this case, we can just sum across for all of these rows other than the cost per unit. Okay, well now let's take a look at Schedule 6, the cash budget. The beginning balance in cash for quarter 1, January 1st of year 4, would be the ending balance at December 31st, year 3. So this amount comes straight off of the balance sheet that was given to you in the problem. Cash collections or cash receipts comes from Schedule 2. Cash disbursements for inventory comes from Schedule 4. Selling and admin costs comes from Schedule 5, but notice I made this little note here as a reminder that since this is a cash budget, we only want selling and admin expenses. Well, the schedule gives us selling and admin expenses. That'll go on the income statement. This is a cash budget, so we need to leave out anything that didn't take cash, and that means depreciation. So this is the $280,000 total selling and admin expense budgeted for quarter 1 minus the $3,000 that's depreciation, because depreciation does not take cash. There's no interest paid here in quarter 1. The dividend information was provided to you in bullet point number 6. Total cash outflows is just the sum of these numbers, $753,000, and ending cash balance is our beginning balance plus our receipts minus our disbursements. That's where you get the $109,800. So formula-wise, this is cash available minus disbursements. This number has to be at least $30,000 at the end of every quarter, or Attaboy will have to borrow money and pay interest on those borrowed funds. Now, one thing to note is cash at the end of quarter 1, of course, becomes cash at the beginning of quarter 2. Follow that same logic all the way through. Remember to adjust for depreciation. In quarter 3, you'll see from bullet point number 5 that Attaboy purchased land for $500,000. So this is a cash payment made for land. Because of that large purchase, at the end of quarter 3, Attaboy has a deficit in cash, a projected deficit in cash of over $22,000. In order to keep a cash balance of at least $30,000, they need to borrow from the bank. They're told that they have to borrow in increments of $10,000, and that's as much as anything, just a simplification of the problem for us. So in order to get this number to be at least $30,000, the minimum amount they could borrow is 60 grand. So that's where the 60 grand came from. In the next quarter, Attaboy will pay interest on this 60,000. So that's where the interest comes from, up here. Let's take a quick look at that formula. The problem tells you that they pay 12% per year, so that's 1% per month. There's no compounding. So this 1% is the interest rate. I've multiplied it times 6 for 6 months, so 1% per month times 6 months times the 60,000 borrowed is where I'm getting the 3,600. Why 6 months? Again, we made a simplifying assumption. We're assuming they borrowed at the beginning of quarter 3 and paid back at the end of quarter 4. So that's why there's 6 months in this computation. Read problems carefully to follow the rules that they've devised for that problem. At the end of quarter 4, you can see that their cash balance is very high again. It's up to $293,600. So they have plenty of cash to go ahead and repay that loan of $60,000 and still maintain more than their $30,000 minimum cash balance. The other thing to note here is the total column. All of these rows will just foot across with a few exceptions. It doesn't make any sense to foot beginning cash balance across. That's a balance sheet account, so you don't add them up. Again, think of this total column as the budget for the year. So this would be the beginning balance in cash at the beginning of the year. The ending balance in cash needs to be the balance at December 31st, year 4. That comes from quarter 4. If you foot these things properly, when you do the math, this $233,600 should work vertically math-wise, and it should be equal to the ending balance at the end of quarter 4. Let me move that up a little here to make that more clear in case you couldn't see it. The math should work in this column so that the column does add up vertically, and this amount, if you've done everything correct, this amount should be equal to your cash balance at the end of quarter 4.